In this video, we're going to be talking about a planning tool called the rental grouping election for rental real estate investors. And as you know, or if you don't know, we can send you the presentation and some additional videos. If you have a loss on your rental properties, you have to fit one of the two exceptions to be able to deduct that loss. And for most rental real estate owners, the exception that's going to be easier to fit, because the other one's based on income, is to qualify as a real estate professional. We're going to have another video on how you qualify as a real estate professional, but assuming you do qualify as a real estate professional and exhibit what's called material participation, we're going to have another video on that as well, then things are looking good for you to deduct a rental loss. These qualifications are based on the amount of time that you put in to the activities. Well, the problem becomes, what happens if you have 5, 10, 15, 20, or several different real estate activities? It's physically impossible to qualify time-wise to have 750 hours into each activity. So the IRS came out with a rental grouping election for us to follow. This is an article from the Journal of Accountancy from 2014 that kind of explains, hey, each interest of the taxpayer in rental real estate is treated as a separate activity for purposes of determining whether the taxpayer materially participates, unless the taxpayer qualifies as a real estate professional and elects under Section 1-469 to group the rental real estate activity. This is Revenue Procedure 2010-13. I really hope you've never read this, but this just goes into the IRS's technical interpretation of this rental grouping election. So if you are a qualified real estate professional, you have material participation, and you have several different activities going on in your tax return, and you want to deduct your losses, make sure you're making a rental grouping election. Thanks very much.